Firstly, gents, thank you for joining us. And for our audience, we have an excellent panel, all of which are the perfect people to tribute John Maynard Keynes. And so we're going to talk a little bit about Keynes, his work, and I think it might be an interesting point to start off as a jumping off point. Just why is this man so influential?
I mean, I would say there's three main reasons why he's influential. First, Keynes came up with his ideas after the Great Depression. So there was a lot of suffering going around, but mainstream economics didn't really have an explanation for crises. Mainstream economics only said there must be supply shocks and that's it. So he came up with a different theory about it. So there was that. Then the second point is, his ideas came out when national income accounting became prevalent. So there was a way to calculate GDP. So math became like much more important for economists, and then people could see like, hey, now we can manipulate these numbers to steer the economy in the way that we see fit. And then the third reason is, of course, it gave a blank check to government and say like, hey, off you go, guys, and you can fix it all, which of course was not the cure.
It was a blank check to governments, but it was also absolving the banking system of any responsibility in the macroeconomic cycle by essentially generalizing the culpability, the guilt of what happens in the business cycle to everyone. That is, that everyone's animal spirits, the bull and the bear, market psychology is responsible for the market cycle, and there is not any specific responsibility towards the banking system, how it's regulated, and how its participants are operating.
Yeah, so we can think of it as up until Keynes popularized certain ways of thinking, and arguably they became popular because they gave more power to a large state. And previously, it wasn't seen like there was such an active need for the role of a government. It wasn't seen like the government must actively manage various macroeconomic statistics or aggregates. And perhaps that's another area of error where Keynes went into error in the general theory, where he speaks about various aggregates, and these aggregates don't necessarily portray an accurate picture of what's going on the ground. So is there anything you guys want to expand on that idea around macro and Keynesian aggregates?
I mean, I think what I always anchor to, and I think kind of if you go back and look at kind of the historical back and forth, Keynes and Hayek were kind of the same vintage, and there were actually quite a bit of active dialogue between those two where they were debating their own perspectives on economics. And that I think that in theory, people want to be able to measure things perfectly and then engineer society in a better way. But the reality is our societies, our economics are incredibly complex, and that the aggregates are the outcomes of many things that are constantly changing. And so rather than using that as a way to describe current economic activity, it would then be flawed to then say we can control outcomes by the measurements of those outcomes themselves. And that I really anchor to kind of an understanding where Hayek talks about the price mechanism and understanding what changes in prices mean, and that they're really the aggregate of millions of individual decision points, not just of individuals, but of each individual transaction, and that describes in many ways human action versus saying, let's take 100 million or let's take 1 billion people and then try to measure everything they do to drive how we want them to behave in the future.
And I would say this was one of Hayek's biggest regrets, that he was not arguing against the general theory during that time, because Hayek was debunking a previous book of Keynes. And he was actually saying like, hey, this is all wrong. And then Keynes says like, and conceded the point, oh yes, I was wrong, but I changed my mind. And Hayek was then after that like sick of it and said like, I don't care anymore. He just like changes his mind again. And he didn't critique the general theory. And later in life, Hayek said like, oh, I should have really gone after it hard. Because this is also what Friedrich August von Hayek is talking about, this term of scientism. All of these numbers, it looks incredibly scientific. And economics always had physics envy. They want to be as predictable, as, I would say, scientific as the other disciplines, the natural disciplines. And so what Keynes put forth was very appealing to these folks. And those numbers, as Parker said, they don't mean all of the things that we think that they mean. Additionally, the life that we are living with our free will and as human beings is infinitely more complex, but it gave really the aura of control that then policymakers, politicians, and so forth really flock to.
And even if the numbers were correct, the politicians can construct any narrative around them that they want. So for example, we saw when inflation, consumer price inflation, that measurement started increasing, politicians would just wave it away and say, oh, it's transitory. So they didn't have that based on any kind of foresight on their part. If they had that kind of foresight, they would be getting rich running a hedge fund, not being politicians. So even just having the numbers at all, that just gives them tools for creating narratives that suit their own political ends rather than actually trying to manage the economy in a reasonable way.
Yeah, and I think this whole question around aggregates, it belies a misunderstanding of what economics is. It's to understand, and I think this is where, for those of us out there, as Bitcoiners, we're thinking of what is the way to think about money, what is the way to think about economics, and we have to think of it from various deductive principles that we start with a certain idea. So for example, man acts purposefully. And then from this, what things can we reason from there? As opposed to this approach of, as Wolf was saying, it's physics envy. People think that that is the way you do economics. You go out in the world and you test these different hypotheses. But the problem is, you end up committing a fallacy of composition. You think that this experiment will be repeatable, but in reality, it's simply not. We can make different decisions. And we have to, actually the way of doing economics is to reflect deeply on what was that human trying to achieve. So I'll give you an analogy. It would be like trying to look at the data of all the people walking around Grand Central Station and trying to understand, oh, why are all these people moving through the station before work and after work? But if you understand as a human, they're trying to get to work, right? Man acts purposely. They're trying to get to work. They're trying to get home from work. And I think that is belying more of an Austrian method as opposed to the Keynesian method. Are there any other comments that you guys want to add at this point?
Yeah, what comes to mind is as well that Keynes, even though he called it a general theory, he didn't have one. He had a specific fix for a specific problem, saying like, okay, if there are crises, then you have to increase government spending or increase the monetary supply. That's what he was proposing. However, he didn't have like a long-run theory of growth, and he was not able to embed it in a greater economic way of thinking. And this is still the problem to this day, because microeconomists, even the mainstream ones, they don't understand macroeconomists. So I was thinking back when I was in grad school, I was like listening to a presentation of a macroeconomist, and there was like a labor economist sitting next to me. He was turning to me and said like, I have no clue what's going on. So it's like one discipline, but they cannot really talk to one another. And macroeconomics is not tied to microeconomics. And so how can you come up with a unified theory that can explain how the world works if that doesn't work? However, the Austrians, as you've said, they do have that.
Yeah, and I would just add, I think to that point of, he didn't really have a theory. It was more when the economy slows, the government should step in and that we can smooth out business cycles based on government intervention. But governments are just people. So all that actually changes is who's allocating capital and how you're paying for that or how you're financing it. And that when you have a small group of people allocating a larger and larger share of an economic system, those few people have an inherently limited amount of information versus the market. And to Wolf's point, there wasn't actually a principle when someone would say, well, why will the government be able to allocate capital in these times better or worse than the market? And he had no explanation for that. There wasn't a fundamental economic principle that said that would be the case. And I'd say more broadly, it's when that market is slowing, it is because the economic actors are responding to all the market conditions and resetting prices based on what the economy and what the participants within that economy in various different places actually value. So the whole idea in my mind was flawed, not just from a principles perspective, but then also anchored to the fact that there really wasn't a first principle to defend it in the first place.
Even if it was the case that politicians were effective at allocating resources during a crisis or during a downturn, the other missing piece of Keynes's theory is what happens during the good times. If in a completely rational environment, what would happen during the good times is that politicians would run surpluses, right? They would accumulate the resources that they will need in order to respond to a future crisis. But what public choice theory and others have found is that politicians during the good times, they're still thinking about how do I maximize my popularity? How do I get votes in the next election? And increasing taxes while cutting spending so that you can run a surplus is deeply unpopular. And it's seen as austerity and is a negative headwind for economic growth. And so by that logic of trying to get reelected every 2, 4, 5 years or whatever it is, they never get around to the important part of, hey, we have to pay for the government intervention that either has occurred in the past or will occur in the future. Keynes completely hand-waved that away and just assumed that somehow it would all work out.
Another big topic in the world of money and monetary theory is this concept of hoarding. Now, this is, I'm sure all of you will have something to say on this. So, is hoarding bad?
Oh, you mean savings? Yeah, I think that, and Pierre and Wolf and I were joking in the back that one of the talking heads on Bloomberg, Joe Weisenthal, always talks about, or not always talks about, but he'll have this line where he says, why should people get paid interest for not taking risk? And he's describing people that have their funds in the bank, and also kind of describing this QE world where interest rates were taken to zero. But it harkens this idea of people saving and getting rewarded for savings. In my view, it's if someone has saved money, it's because they've already taken risk, and that savings is an important, very important part of the economic system because all investment and consumption comes from savings. And that when there's an incentive to save, you have more savers, and then you have more people in an economy that can actually consume and invest. And when I think about this in the context of Bitcoin, there will only ever be 21 million Bitcoin. And what that means is that no more, no less than 21 million Bitcoin can be saved. You can't save more than 21 million Bitcoin, but the fact that in aggregate more can't be saved, it actually creates the incentive for there to be more savers. And in that world, everyone is incentivized to, quote, hoard, but all they are really doing is deferring into the future when they will consume or invest what they've produced in the past.
Yeah, and I think the interesting point about that is also the innate fear. Like people saying, oh, it will be deflationary, and then like all of the prices are going down, and we will not be able to dig ourselves out of that anymore. And that's what all Keynes really added to it. It said like, okay, if people have a deflationary spiral because they're saving more, that will just lead really to the worst possible outcome. But that's not really the case, right? Because people have to consume. We've heard Robert Breedlove earlier today about saying we have infinite wants, right? Even if you're very rich, you have to probably take care of all of your 3 houses that you have, right? And you have all kinds of other problems. So there's always something that we want to solve. So we have to spend at some point. But he just said like, okay, because wages are sticky, right? The prices cannot adjust very quickly. Therefore, we need government to step in. But he just prolonged really the cure. So to give you a metaphor, if the problem is that in the economy as a living organism, there is a tumor in your lungs, Keynes just gives you one cough drop after another over decades and decades and decades. And I believe we are like now at the end of that because we need like surgery, and Bitcoin is the surgeon. And so I think that is the opportunity now, and I'm glad to see so many here in the audience of people who are understanding that, and the world is waking up to that.
I want to really zoom in on something Wolf brought up, which is the wage stickiness, because I think this is actually kind of the crux of the issue in the area of deflation. So it's not a problem for consumer prices to be going down, right? Everyone's happy about that, except the producers, right? The producers, firms, companies, they always want to be increasing their prices, but if we're in a free market, there's competition, the prices go down. What Keynes really emphasized was the problem of wages going down. And his argument was that people don't want to be paid less, and so they would rather be unemployed than get paid less if wages are going down. And this is actually something that has been measured. It's a real effect. The trade-off, though, is that if you want to stop that from happening, is that you have to create inflation and make it so that real wages are going down even if nominal wages are going up. And the trade-off there is essentially, hey, let's have lower unemployment and lower real wages rather than higher real wages and higher unemployment. And my argument would be, who is Keynes or anyone else to make the value judgment that unemployment is worse than low real wages? We see now over the past 50 years of wealth inequality that has dramatically increased. The effect of driving down real wages favors companies, it favors profitability of shareholders, and has dramatically increased the wealth inequality. And when it comes to unemployment, sure, it's obviously a negative, but we can also look at it as an opportunity, right? You're unemployed because you currently need to change your skill set, change your geography, change any kind of different things about how you're going about creating value in the economy. And so it's actually not necessarily bad to have unemployment, right? Because there are structural changes happening in the economy where we do need people to be learning new things and out of the workforce for a little bit in order to find the right new opportunity. The part about, everyone is always, on the 21 million Bitcoin and dollars, this is true for dollars as well, it's always being held by someone. So there's not some kind of fantastical situation where the money is in circulation and it's not being held by someone. Money is always being held by someone, and you could argue it's hoarding or not. That ends up just being an argument about how long should people hold money for, right? If you hold money for 2 weeks, you're living paycheck to paycheck. Keynesians think that's great. But if you start holding money for months or years, now they start having concerns about you hoarding money. The reality, though, is that you might not have an investment opportunity or a consumption opportunity on your radar for months or years. And so why should the government force you, push you, incentivize you into a bad investment like subprime mortgages or a bad consumption opportunity like cheap, plastic Chinese things? So you've got a policy that is really trying to shorten people's time horizons so that they go and spend their money. And obviously the politicians benefit from the GDP number going up and then getting reelected.
Yeah, and one of the things too, I think, and there's a book called Keynes and Hayek that I really recommend people read, because I think one of the best things about Bitcoin is there's, and if you go back and read history in the 1930s, 40s, when Keynes and Hayek was having this back and forth and they were actually responding to each other, it was an economic debate. And the question of, why was Keynes so influential? Honestly, I believe it was just a psyop that, his frame of thinking was what the people in power wanted to pursue and gave him an excuse to do that. But it was an intellectual debate, and now what we have is a market test. We have an economic system that is the legacy system, that is a Keynesian system that's centralized and where they pursue these actions to manipulate the money supply, influence the economy via fiscal spending. And now you've got the Austrian system. And those two systems are competing with each other. And so the intellectual debate is in theory, but now what we have is in practice competition, and we'll see what system survives and what rational economic actors actually pursue, one of free markets versus one of manipulation.
And you added like a great source, and just like for the audience here, if you're not so familiar with Hayek and Keynes and all of these different aspects, you should go to YouTube and type in Hayek versus Keynes rap battle. It's basically like a rap battle between those two giants, and it's very interesting. It will explain those theories very well.
So fundamentally, we have this conflict between the legacy system and the Bitcoin parallel system. And I think it's important for people to understand what's at stake, because if that intellectual battle, if people don't understand, then they can fall back into the same trap. And so as an example, we're seeing now people talking about this idea with central bank digital currencies and having demurrage, this idea that you can't hold that currency for longer than a certain period of time. It's like a very Keynesian idea, because from their point of view, that's hoarding, and hoarding is bad. And on the other hand, we have this vision supported by the Austrian economists, which is saving is good. Saving is how an economy grows. So we've only got about a minute and a half left, but if there's any other final points you'd make for people on why they should care about understanding some of the theory or the economics of it.
Yeah, Satoshi Nakamoto wrote that the fundamental problem with traditional currencies is all the trust involved, and that you have to trust the issuer of the currency to not inflate, to debase the supply. And we really, I think, should be grateful that Keynes came along and encouraged politicians to abuse this trust so that it could then motivate the reason why Bitcoin exists. And so while we can criticize Keynes, I think that ultimately his ideology is what led to the creation of Bitcoin. Otherwise, we would still be under the gold standard.
And another point, because it's a tribute to Keynes, I think Keynes, compared to many other economists, really understood the power of economic ideas. Right ones, but also wrong ones. And he also understood if you enslave a nation into debt, that will lead to political turmoil and will lead to even worse atrocities like in the Second World War. He saw that coming. And I think we are in a similar situation right now, and we need to take that to heart.
So I think that's pretty much all we have time for. So just keep that in mind. Consider why there's this underlying reason to understand sound economics and unsound economics. Make sure you follow all of our panelists. So we've got Parker Lewis, Wolf von Laer, and Pierre Rochard. So everyone, please put your hands together for our panelists.